Thank you, Jenny, and thank you everyone for being on the webinar today. I know we've got a lot to cover, so I'll get right to it. We've had a very strong and very successful session. You're going to hear a lot today about assessments, annexations, solar base rate, CUME funds, just to name a few. And as you can imagine, we've already started planning for the next session. But as I said, from DLGF's perspective, we had a very effective session. That success was due in large part to our preparation, and along with the help and collaboration of a large contingency of stakeholders. And I want to name them today. And of course, as I said this morning, I'm going to forget somebody, and I did. So I'm going to include a couple more this afternoon. But AIM, Matt Greller and his team at AIM were great partners with us, as were Dave Bodorf and the group at AIC. Their affiliate groups, the League of Clerk Treasurers, Assessors, and Auditor Group, were very, very supportive and very helpful to us. Denny Kosterison at IASBO, school superintendents, and Dr. Koopman, our school board association led by Terry Spradlin, our library association, Lucinda Nord, very supportive. Debbie Driscoll and the Township Association, Indiana Farm Bureau, Indiana Manufacturers Association, Indiana Chamber, and I would be remiss if I didn't also mention the tremendous partnership that we have with the House and Senate fiscal staff, Ben and Liza, Krista and staff. We appreciate all the work that we've been able to do together. I would also want to call out and shout out, if you will, our Auditor of State and her staff. Auditor Klutz has been very helpful with her and her staff. State Board of Accounts, our favorite state examiner, certainly, and his staff has been very helpful. Department of Revenue, IFA, OMB, and IBTR all were involved with our effort to not only get 1271, House Bill 1271, across the finish line, but a myriad of others. You're going to hear about at least 15 different enrolled acts today, and that's just a small amount of that we were following during the session. I also want to thank the chairman, Chairman Brown of Ways and Means, and Chairman Oldman from Tax and Fiscal for their availability. And then, of course, I forgot this morning to thank, especially thank our author of the bill of 1271, Senator or Representative Dan Leonard, and then Senator Eric Bassler for sponsoring that on the Senate side. And then finally, last but certainly not least, Emily Chrysler, my general counsel and legislative director here at DLGF, along with her team of David and Kelly, did a remarkable job getting us prepared and shepherding 1271 across the finish line 3 weeks early. But we needed that 3 weeks in order to work on these other issues that you're going to hear about now. So thanks to all those folks and to my staff here at DLGF, and thank you to you for your support and your input. And Emily, I'm going to turn it over to you now, and you and Dave and Kelly, and tell us what we need to know. Thank you all.
All right, thank you, Commissioner Bennett, for those kind words. As he referenced, the 2021 legislative session was interesting, as is all legislative sessions. So we thank everybody for all the work that they did, and we thank all of you for joining us this afternoon to kind of go over some of the highlights of changes that occurred during the most previous session. I'm joined this afternoon by David Marusars and Kelly Elliott. Kelly primarily works with our assessment division as well as the data analysis, and Dave works with our budget division as well as the information systems division. So like Wes mentioned, we have a lot of topics, so I'm going to go ahead and jump right into it. First slide we have here is our typical disclaimer. So the information that we're going to convey today is just guidance and our interpretation of highlights of the different legislative changes from the last session. It's not a substitute for reading the statutes in the Indiana Code. So make sure that any references that are here to bills or statute, you take a look at those as well. We've also provided legislative update memos. We'll be continuing to release more of those in the coming days. So we do have a litany of different issues. There are 7 different topics that we're going to cover during this afternoon's webinar. So I'm going to go ahead and turn it over to Dave for our first topic, dealing with local budgeting matters.
Okay, thank you, Emily. So we're going to go right into talking first about annexation reporting. House Rule Act 1271 made some changes to how annexations are to be reported to the DLGF. First, for a fiscal officer of each political subdivision that annexes territory in the prior year, before June 15th of each year, the fiscal officer has to provide the DLGF with a report of any annexation that takes place in the prior year. That could include not only municipalities, but also any special taxing district that is able to annex and add to its boundaries, such as conservancies or fire protection districts. Next slide. 1271 includes an additional requirement of the auditor to forward to the DLGF a list of lots or lands disannexed, as well as a copy of any annexation ordinance filed under the municipal annexation laws. This must be done no later than August 1st of each year. So for county auditors, under the municipal annexation laws, the auditor has to provide the list of lots and lands disannexed and any annexation ordinances to a number of different local and state government agencies. This 1271 just adds the DLGF to that list, and in particular to the DLGF, like I said, the auditor has to provide this information no later than August 1st. And this is particular to municipalities. Moving on from annexations over into additional appropriations, 1271 did a couple of things. First, specified that any additional appropriations submitted to the DLGF must be in the manner prescribed by the DLGF. As many or all of you know, last year we launched the Gateway Additional Appropriations application to allow electronic submission of additionals. So 1271 just adds that going forward, the Gateway Additional Appropriations is the means by which additionals need to be reported to the DLGF. It also 1271 also clarifies that appropriations for bond proceeds must be included in the budget for the ensuing year. Failing that, the unit must complete the additional appropriation requirements in the year in which the bond proceeds are received. Next slide. Going over to talking about cumulative funds. So 1271 had these requirements, made these changes. First, beginning July 1, 2021, the department's review of cumulative fund establishments and reestablishments will be limited to certifying whether the proposed tax rate does not exceed what is permitted by statute. Under current law, the DLGF is required to approve, modify, or disapprove a cumulative fund establishment or reestablishment. However, does not, the statute doesn't give a standard of review for what the DLGF is supposed to look at when making its decision. 1271 just says that the review is limited to whether the tax rate adopted for the cumulative fund does not exceed the statutory maximum. The exception, however, is in the case of a taxpayer remonstrance. Under current law, taxpayers are able to remonstrate against an established or reestablished cumulative fund. In the case of a taxpayer remonstrance, which would then require a hearing by the DLGF and then a decision, the DLGF shall only review whether the statutory requirements were followed, and that includes the requirements for the unit under 6.1.1 or IC 6-1.1-41, related statutes in the public notice laws, IC 5-3-1, and then any statute in particular to the cumulative fund, like the statutes for the major bridge fund, cumulative bridge, capital development, and so on. Finally, on the same topic as the remonstrances, the current law has a list of different requirements for the taxpayers. In particular, how many taxpayers are required to sign a petition to remonstrate against a cumulative fund, and that will vary by cumulative fund type. So for example, the cumulative fire fund, 10 taxpayers are needed to sign a petition. The cumulative capital development, it's 50. I believe for county voting machine cumulative fund, it's 100. And because units have to advertise in the notice of adoption and let the taxpayers know that they do have a right to remonstrate, the varying numbers under the law create some inconsistency and some confusion as to how many taxpayers are actually needed. So 1271 also makes the number of required taxpayers uniform for all cumulative fund types, and that I think you need 25 taxpayers required to sign a remonstrance. Moving on from cumulative funds to rainy day funds, 1271 has a provision allowing political subdivisions to transfer into the rainy day fund an amount from 10% to 15%. Now, this is only for a 5-year period for calendar years 2021 through 2024. The amount that a political subdivision may transfer into its rainy day fund from its other funds can go from 10% to 15%, which means that beginning with calendar year 2025, the transfer limit will return back to 10%. So it's only for the next 5 years that the transfer is allowed up to 15%. Moving on to talking about TIFs, 1271 specifies that upon receiving notice of any excess value allocation from an RDC, the auditor must forward this notice to the DLGF by June 15th. Under current law, the RDC must inform or must provide the report to the county auditor and to the department by June 15th, but they're separate reportings, and they created some inconsistency in the reporting. And so this just streamlines the reporting so that it's to one office, the county auditor, and then the auditor who gets it from the RDC then forwards it on to the DLGF. And the June 15th deadline is just, it remains the same. It's just how the DLGF receives the excess AV report. Also on the topic of tax of TIF districts, 1271 also prohibits a real property parcel from being included in more than one TIF area. Now this only applies to TIF areas or parcels included in a TIF area after May 1st, 2021. Any TIF, any parcel that is located in more than one TIF district on or before May 1st is allowed to remain in multiple TIF districts. Okay, moving on from local budgeting matters to more specific township and fire protection legislation. First, regarding township annual reports, Senate Enrolled Act 409 requires that the trustee certify in the proposed budget submitted on Gateway that the uniform written standards for township assistance has been filed with the Board of County Commissioners. Now, the provision itself in 409 refers to the budget submitted under IC 6-1.1-17-3, which is the budget notice statute, or the budget notice is also known as the Form 3. And without further clarification, our understanding is that the certification needs to appear on the Form 3 because of the citations of the statute. Now, I will point out that in the budget notice statute, there was provision saying that if certain items are not included in the Form 3, or if there's or if the Form 3 was not submitted by a certain time, the unit's budget would be continued. This reference that particular section in the budget notice statute does not refer to this requirement for the township, the trustees certifying the uniform standards on the Form 3. So our understanding is that the failure for the trustee to submit the certification on the Form 3 is not in itself grounds for continuation. Along the same lines, Senate Enrolled Act 409 also requires the trustee to include on the Form 3 the township assistant's phone number, and likewise, because there's no reference back to the continuation provision in the budget notice statute, failure to submit the phone number is not in and of itself grounds for continuation. Moving on to the township abstract, this is also under Senate Enrolled Act 409. In particular, the statements of receipts and expenses. 409 provides that the statements of receipts and expenses that are contained in the township abstract do not have to be published in the newspapers. However, the remaining portion of the abstract does have to still be published in the newspapers. And if the statements of receipts and expenses are excluded from what's published in the paper, also has to include a statement that a complete abstract is available for public inspection at the county auditor's office. Going on to talking about township type voting, Senate Enrolled Act 483 specifies that the township trustee is able to break a tie for purposes of casting a deciding vote by the or on a tie vote by the township board. The exception, however, being that the township trustee cannot break a tie if the vote is related to an ordinance increasing the trustee's own salary. So now we're going to talk about, mention some things about fire protection territories. House Enrolled Act 1065 makes 3 changes to the fire territory laws. First, by allowing for the expansion of existing territory, changing the process for how one is formed or expanded on, and then also addressing territory executive boards and how they are and their composition. So under current law, to add area to a territory, the territory would have to be dissolved and then reformed. And because of the way the fire territory establishment statutes are drafted and the timeframes in which such actions have to be taken by the participating units and when they go into effect, there is a possible multi-year cycle in which a territory would have to dissolve and reform just to add an additional unit or area. So 1065 intends to simplify this process, and it intends to do so by stating that the participating units and the unit that wants to join the territory follow the same process as establishing a territory, and that includes the public hearings. And we'll get into more about that in a minute, as well as adopting identical ordinances and resolutions, and all doing so within the first 3 months of the year, which is the process under current law. So talk more specifically about the actual process. 1065 adds a public hearing that the units must hold prior to adopting an ordinance. Right now, the requirement is only 2 public hearings. Obviously, units can do more if they want, but before they can adopt ordinances and resolutions to establish a territory, they have to do 2. Now they have to do 3. The first public hearing must be held at least 30 days before the adoption meeting. And at this first hearing, the legislative body of each participating unit has to make available to the public information regarding the territory's impact on taxes, service levels, capital improvements, etc. This is information that is already required to be provided to the public by statute. 1065 just clarifies that this is to be provided at the first public hearing. As for the next 2 hearings, they would have to be held no later than 10 days before the adoption meeting. So you have a 30, for formation of a territory or to expand a territory, there's a 30-day period between the first and then the first hearing, and then the adoption meeting, and in between that time, but no later than 10 days before the adoption meeting, you have to have those 2 public hearings, and they all have to be, the hearings and adoption meeting have to be noticed under the public notice laws, including publications in the newspaper. The ordinance resolution to adopt or create a territory or expand one must include an agreement as to how territory or property held by the territory will be disposed of in case of a withdrawal or dissolution. Finally, on the topic of territories, 1065 adds a statute regarding executive board composition. Now, executive boards are not by themselves required by the fire territory laws, and they are, for that matter, before 1065, not really contemplated. But it's what some territories through their participating units have created by agreement as a way to facilitate various financial administrative functions of the territory. And so this provision, this new statute, really only applies first to territories formed by ordinance or resolution after December 31st of this year. And then also, if the agreement to form the territory also delegates responsibilities to this executive board. And so in this case, what 1065 does is that when you have a board, the board must include at least one voting member who resides within and represents each participating unit and who does not reside in any of the other participating units. So for example, if you have a territory that is composed of a township and a municipality, like say a city, and the city is contained within the boundaries of the township, and the trustee not only lives in the township, but also in the city. What 1065 says is that in order for the trustee to serve on the board, the trustee actually has to live outside the city's boundaries, because the city is a participating unit, and the trustee is not of that unit. The trustee is a township official. I will mention though that the executive board composition itself is a matter that is not of DLGF oversight. So we'll just go right along to talking about education finance. 1271 made some changes to how the referenda, how property tax referenda are held, but also probably most notably, it overhauls the form language for the ballot question, as well as make some additional requirements for the school board. First, on the topic of the ballot question itself, the form language for the proposed ballots are changed for controlled projects, school operating referenda, the referenda to renew an operating referendum levy, and a school safety referendum. Briefly, the controlled projects, it not only applies to school corporations, but also to local units that ever is going to plan for a controlled project. So the form language itself is different in a few ways. Just want to point out the more significant ones. First, it requires that the county auditor determine and the DLGF certify the average percentage increase in property taxes for residential and business property. It also requires that the unit give information about when the last referendum was held by the property tax referendum was held by the unit, and then a statement of whether the last referendum passed or failed. What won't be included in the form question is the proposed property tax rate that would be imposed on the taxpayers. Therefore, taxpayers will no longer see on the ballot itself the additional tax rate that would be paid if the referendum passes. There are some other things that and some uncertainties, I will say, about the referendum question and how the templates are supposed to work, or what they're meant, how it's supposed to be implemented. I do want to make a plug at this time that the DLGF is going to be holding a webinar on July 15th on matters particular to referendum, not only an overview of the referendum process, the property tax referendum process, but also the changes made by 1271 and some of the particularities about the legislation, and like I said, some uncertainties about how to implement it. I also want to make a plug for a memo that the DLGF issued on May 27th, entitled Property Tax Referendum Calculations. As I mentioned, the auditor has to determine the estimated average percent increase in taxes. 1271 does include a multi-step process for doing so. And so the memo outlines the various steps and how the DLGF believes how the DLGF believes it is meant to be implemented. Going on specific to some other matters about the referenda. So Senate Enrolled Act 398 changes the deadline for school corporations seeking to place a school safety referendum on the ballot for a primary election. So this is meant to make the deadline, the certification deadline, uniform for all the property tax referendum types. For the general election, it's the same across the board. It's August 1st. But for the primary, for the other three types, it's 74 days before the primary. But school safety right now says it has to be 60 days. And so 398 just makes it 74 days to make it the same for all property tax referendum types. Talk about the other major topic about referenda. Senate Enrolled Act 55 adds requirements for school corporations that both seek a property tax referendum and impose property taxes due to a referendum. It requires a school corporation to develop a revenue spending plan for an operating or school safety referendum. And what must be included in the plan is an estimate of the amount of annual revenue expected to be collected, the specific purpose for which revenue collected from the levy will be used, and an estimate of the annual dollar amounts that will be expended for each purpose. On top of that, the school board must submit the following to the DLGF at least 10 days before its budget hearing. First, purposes specified in the public question or any revenue spending plans for debt service on bonds or lease rentals, as well as the operating referendum levy or school safety referendum levy, as well as information about the debt service levy fund, operating referendum tax levy fund, or the school safety referendum tax levy fund. And so going away from referendum to talk about other relevant matters for education, school budgeting. 1271 also specifies that a school corporation that operates its budget on a fiscal year basis must submit its budget notice in the same manner as school corporations that operate their budgets on a calendar year. This just adds some uniformity, and this actually reflects current practice for those schools that are on a fiscal year basis. Finally, on education finance, we'll explain some changes about temporary loans and anticipation warrants. First, for temporary loans, 1271 specifies that before a school corporation increases the debt service levy to pay the interest for a temporary loan, the loan must have been issued and the school corporation has received the proceeds from the loan. It also provides that the school board may not authorize a temporary loan for the purpose of increasing the school corporation's property tax rate for the ensuing budget year. With regard to anticipation warrants, House Enrolled Act 1001 and Senate Enrolled Act 55 specify that before a school corporation increases the debt service levy to pay the interest on an anticipation warrant, the warrant must be authorized by the school board in a resolution adopted at a public meeting in the year immediately preceding the year in which the warrant will be issued, and the resolutions will have to be submitted to the DLGF. So with respect to temporary loans and anticipation warrants, 1271 and then 1001 and 55 with regard to the warrants, they impose some additional requirements, but they are distinct requirements depending on whether the school board is seeking a loan, a temporary loan, or an anticipation warrant. So that sums up everything that I have to cover. I will then turn it over to Kelly to start talking about assessment matters.
And before Kelly goes ahead and goes over the assessment updates from legislation for the past session, I'll just remind everybody, we've already received a number of questions in the Q&A section of today's webinar. Please feel free to continue posting questions. We may run out of time before we're able to get to all of these questions, but at the conclusion of our webinar this afternoon, we will be compiling any questions submitted during this morning's webinar or this afternoon's webinar into an FAQ document that will be posted in the coming days to address any questions that we don't have time to get to here. So feel free to continue to send those along in the Q&A section, and I will now turn it back over to Kelly.
Thank you, Emily. Like Emily said, I'm going to cover some of the legislation from this last session that affects assessment matters. So the first bill is House Enrolled Act 1271. Section 6 of 1271 clarifies that petitions for reassessment of partially or totally destroyed real or personal property, that being Form 137R, must be related to property that's been physically destroyed. The term physically was added to the statute that provides this relief. So petitions for reassessment should not be filed for properties claiming to have been only economically impacted. And this bill was retroactively effective January 1 of 2020. Section 5 of 1271 is related to business purpose personal property returns. It states that if a taxpayer consented to receive notifications by electronic mail from the taxpayer's township or county assessor for personal property filings, this consent remains in effect unless revoked in the calendar year immediately preceding the filing year. Prior to this change, the statute did not specify how long a taxpayer's consent to receive electronic mail remained in effect. So these taxpayers that elect to receive notification electronically, assessing officials may provide assessment notifications by electronic mail as well. The next bill is House Enrolled Act 1166. Section 4 of 1166 outlines a taxpayer's right to file a complaint against an assessing official with DLGF. The bill specifies that a taxpayer may submit a written complaint to the DLGF if he or she has reason to believe that a township assessor, county assessor, employee of an assessing official, or an appraiser does not have the necessary competency to perform the assessment, fail to adhere to the uniform standards of professional appraisal practice, or engage in a prohibited action as outlined in IC 6-1.1-37.5-3. The bill also requires DLGF to respond to these complaints in writing within 30 days. DLGF does plan to prescribe a formal complaint form that may be used by taxpayers for this purpose, but until this form is finalized, taxpayers can submit written complaints to our office via email or US mail. 1166 also requires that assessment notices include a notice to taxpayers of their right to submit a written complaint to DLGF, including the procedure that a taxpayer must follow to submit that complaint to our office. The notices that will need to contain this information are Form 11, Form 113, and the tax statements. Next is Section 3 of 1166, and this section prescribes when a Level 2 or Level 3 certified assessor appraiser can serve as a tax representative. For a Level 2 certified assessor appraiser, they may serve as a tax rep for a taxpayer before PETA-BOA. However, to do so, they must first obtain authorization from the taxpayer on a form prescribed by DLGF, and that form is to be submitted along with the taxpayer's notice to initiate the appeal. And DLGF will issue a new form for this taxpayer authorization before July 1, which is when this section of 1166 becomes effective. Now for a Level 3 assessor appraiser, 1166 provides that they may serve as a tax rep for a taxpayer before the PETA-BOA or the Indiana Board of Tax Review. Unlike a Level 2 certified assessor appraiser, though, a Level 3 certified assessor appraiser does not need to obtain authorization from the taxpayer on a form prescribed by DLGF prior to serving as the taxpayer's tax representative. Next is section 2 of 1166, which relates to assessment appeals. It does add a new subsection to IC 6-1.1-13, so it does have a few different working parts. The bill specifies that for residential or commercial property with an assessed value of $3 million or less, if the assessed value is increased and the taxpayer successfully appeals the increased assessment before the PETA, BOA, or IBTR, the assessed value for the property cannot be increased until the first year of the next 4-year cyclical reassessment. But there are some exceptions to this bill. The bill states that this assessment freeze, as I call it, would not apply to increased assessments based on structural improvements, zoning, or uses that were not considered in the prior year's assessment. Additionally, the assessment freeze would not apply to properties sold during the freeze period for fair market value. If this happened, the assessor can reassess the property that was sold. And the assessment freeze would not apply to increased assessments in subsequent years that are based on trending or the application of an annual adjustment factor. Additionally, the assessment freeze does not apply to all reductions in assessed value. The bill states that it does not apply if the reduction in assessed value is the result of a settlement agreement between the taxpayer and the assessing official, which is another great reason to try and resolve these matters informally. And it also does not apply if the appeal is based on a correction of error under IC 6-1.1-15-1.1A and B. And this is going to be those appeals of what is sometimes called objective issues. 1166 also has limitations on further appeals if the assessed value of a taxpayer's property is in a freeze period. It specifies that the taxpayer may not appeal an increased assessment to the property during the freeze period unless the taxpayer believes the increased assessment is arbitrary and capricious and was not made consistent with the annual adjustment factor. So the last bill I'll cover that affects assessment matters is Section 2 of House Enrolled Act 1348. So this bill provides new guidelines for the assessment of the land portion of the fixed property of a utility-grade solar energy installation facility. The bill specifies that the assessed value of such facilities cannot exceed the solar land base rate for the region in which the property is located. 1348 divides the state into 3 regions, as indicated on the map on the screen, North, Central, and South, for purposes of the land base rate for solar assessments. 1348 provides that beginning December 1 of 2021, DLGF will calculate the solar land base rate for each of the 3 regions. The land base rate will apply to the land underneath the solar panel, as well as to the land in between and immediately surrounding the solar panels. The land base rate calculated by DLGF will serve as the assessment cap unless the facility was in existence and assessed on the January 1, 2020 assessment date. And this is because 1348 does carve out a limited exception for facilities that existed and were assessed on the January 1, 2021 assessment date. The bill specifies that if a facility that falls into that category has an assessed value that is less than the solar base rate for the region, then the land portion of the fixed property of the facility is to be assessed at an amount equal to the assessed value as determined for that January 1, 2021 assessment date. So this carve out in the bill will only apply to assessments of such facilities occurring after December 31, 2021 and up until the county's next planned reassessment of that property during its 4-year reassessment cycle.
And before we move on to the next topic, I'll go ahead and note that beginning on December 1, 2021, this will be the first time that the department will be releasing the solar land base rate calculation, and not unlike the ag land base rate calculation materials that are released by the department each year, we'll be providing the base rate calculation and some supporting material, as well as a frequently asked questions section. We've had a number of questions that have come in with regard to the solar assessment issue, and just to make sure that all bases are covered and that we have as much information out there as we can for this first year under the new structure, we'll try to include a lot of materials to make sure that it is clear going into that next assessment year how these types of properties are handled. And I'll turn it back over to Kelly.
Thank you, Emily. So now I'm going to cover a few bills that impacted exemptions in tax bills. So the first bill is Section 1 of Senate Enrolled Act 195, which makes changes to the tax bill proof of mailing date. So 195 states that a payment mailed to the county treasurer with metered postage is timely received if the envelope is properly addressed to the treasurer, has sufficient metered postage, the metered postage bears the actual date of when it was affixed, and that date is on or before the due date, and the treasurer receives the envelope no later than 5 business days after the due date. So before the passage of 195, payments had to be postmarked on or before the due date to be considered a timely payment, and postmarked was defined to specifically exclude postage printed by a postage meter. The bill removed this specific definition for postmarked, and the date printed on an envelope by a postage meter is now recognized as a mailing date. 195 also provides that a taxpayer will be subject to a 5% penalty if their payment is made late during the initial penalty period, which the bill defines initial penalty period as the period of time up to 30 days after that due date. The next bill I'll cover is Section 1 of Senate Enrolled Act 336. It increases the threshold for the business personal property tax exemption from $40,000 to $80,000. And that is effective January 1 of 2022. Next is Section 1 of Senate Enrolled Act 271, and it relates to the Industrial Waste Control Facility Property Tax Exemption. 271 removes all references and filing requirements related to the Indiana Department of Environmental Management, or IDEM. A property owner is no longer required to forward a copy of the exemption claim to IDEM. The bill also removes IDEM's ability to investigate such claims, and IDEM is no longer required to certify a determination of an industrial waste control facility for an exemption application to the appropriate assessing official. Now, with the removal of IDEM's ability to perform such functions, Section 1 of 271 adds that the local assessing officials may now investigate claims under the industrial waste control facility exemption application and determine if the property is in fact being utilized as an industrial waste control facility. The bill also allows local assessing officials to require additional documentation from the property owner to support the exemption claim. The last bill I'll cover is Section 2 of 1353, which amends the statute that currently provides the property exemption for tangible property owned by or held in trust for the use of a religious society or church. 1353 makes some changes related to the sales disclosure form that Emily will touch on here shortly. But what I'll point out is that beginning with property transfers occurring after December 31 of 2021, when property owned by a church or religious society is transferred to another church or religious society to be used for that same tax exempt purpose, the transferee church or religious society is not required to file a certified exemption application with the county assessor. So if the property remains eligible for the exemption after the transfer, the exempt status of the property carries over to the transferee church or religious society. I'm going to turn it over to Emily Chrysler, and she's going to cover some sales disclosure form legislation changes.
Thank you, Kelly. And as she referenced, for transactions that occur after December 31st of 2021, there will not be the requirement if it is transferred for one entity that is operating under the religious use exemption, transferring to another entity operating under the same exemption to complete the change of ownership or use form, which is typically given to the county assessor or the assessing official to let them know that there has been that transfer. But in place of that, the sales disclosure form is going to include an attestation section that will reference the transaction from one exempt entity to another. As was with other changes that were made to the sales disclosure form more recently that went into effect at the beginning of 2021, any changes to the sales disclosure form require an administrative rule action. This is because 50 IAC 26 has the file form specifications that are needed to support the form fields of the sales disclosure form. So to add the attestation to the form, we will need to update these file specifications. We are in the process right now of initiating and starting that rulemaking process to try to get it done as quickly as possible to have those file specifications up to date and any of the software providers equipped and able to handle this update and change to the form that will need to be in place starting next year. In addition to having this attestation box on the sales disclosure form, the county assessor can request articles of incorporation or bylaws to affirm that the attestation has been made in good faith, and they have to reasonably suspect that the property that's been transferred no longer is being used for the exempt religious purpose. The request from the assessing official must be made in writing, and there must be an explanation as to why the assessing official believes the property is no longer being used for the same tax exempt purpose. And then the next thing that addressed the sales disclosure form through legislation was included in House Enrolled Act 1271, beginning on July 1st of 2021, so coming up here soon. The sales disclosure form filing fee will be increased from $10 to $20. Now, the allocation of the filing fee with 50% remaining with the county and 50% being transferred to the state for assessment training purposes will be the same. So the county portion of that fee will go from $5 to $10. And the fee increase will apply to sales disclosure forms filed after July 1 of 2021, regardless of when the property conveyance occurred. Now, there are a number of different factual scenarios or examples that we have put together in the memo that we have previously released by the office, kind of outlining some different timing scenarios that could take place with this filing fee. So for a property that's sold on June 1st of 2021, the buyer fills out and signs the SDF form on June 10th of 2021, and the seller signs and submits the form on June 15th of 2021. In this case, the SDF is not formally accepted by the county until July 1st. In this case, if the form is submitted before the legislation goes into effect, the $10 filing fee would apply, regardless of whether the filing fee is collected at the time of submission, or if the filing fee is collected later during the form review process. Counties sometimes will have a different process as to which office it's submitted to or at what point in the review process that fee is collected. Example number 2, if a property is sold on June 1st, 2021, the buyer fills out and signs the form on June 10th, and the seller signs and submits the form on June 25th of 2020. However, on July 1st of 2021, the assessor reviews the sales disclosure form and notices that the form is missing the description information that is required in Section D, Question 1 of the form. In this case, if the county needs a minor clarification or a correction to the form that has been submitted before July 1 of 2021, the filing fee would be $10. However, that does not mean that a sales disclosure form and the preparers of the form should submit incomplete forms to avoid being subject to the increased filing fee. It is the recommendation of the department that all county officials that accept these forms work with individuals that unintentionally submitted incomplete or incorrect forms and to not unnecessarily increase the fee. For our last example, we have a property that's sold on June 1st of 2021. The buyer fills out and signs the form on June 10th of 2021, and the seller signs the form on the 15th. The form is submitted to the county on July 1 of 2021. In this example, the fee would be the $20 that has been the increased amount. Although both the property conveyance and the completion of the form took place before the legislation goes into effect, the form itself was submitted after the legislation went into effect and therefore would be subject to the new filing fee. And then the last topic that we have to discuss is going to be public hearings and public notices. It was a very popular topic during the 2021 legislative session, given some of the pandemic concerns and the occurrence of virtual meetings by public officials. So starting out with remonstrance hearings, House Enrolled Act 1271 deals with a number of different remonstrance hearings and that they can be conducted virtually. I've included a list of 5 of the most common ones that we see. However, those that were actually included in the legislation are more than the 5 that are here. Just for the most common ones, we have a budget remonstrance, a cumulative fund remonstrance, lease rental agreement, emergency fire loan, or fire equipment. For these remonstrance hearings can be conducted virtually. During the pandemic, the department had roughly 3 to 5 of these that we had to hold virtually. They went off very well. We had large participation, both from those that remonstrated against the action, as well as members of the public that decided to participate. Going forward, these can continue to be conducted virtually, or they can also take place in person. Next was House Enrolled Act 1437. This dealt primarily with electronic participation and communications by the governing body of political subdivisions. A lot of the requirements in this bill will seem familiar to those individuals that are familiar with how state agencies and/or state boards and commissions have had the authority to participate electronically in official business and meetings. Going through the requirements of what they must have to meet electronically, the first one is that they must adopt a written policy establishing the procedure for electronic participation. This again mirrors the current requirement under statute for state boards and commissions that opt to have electronic participation. There could be examples that are out there as to what those policies include. We are not going to prescribe any kind of examples, but it could be something that is a good reason to contact your public access counselor to see what examples are out there. Next, you must have technology available that permits simultaneous communication between members of the public and board members. This means that there has to be the ability to submit questions. There has to be the ability to see documentation that could be presented at that time, just as if you had a meeting in public and you had handouts or documents that were being presented to the public that they could request copies of. Also, it would be important to keep in mind for the technology that has questions that are asked or documents that are being presented to members of the public, these will be considered public records. So you'll want to make sure that you keep them in accordance with APRA and the open door law. Number 3 says that at least 50% of the members must be physically present. This means that for those members that are unable to attend a meeting in person for whatever reason, we still need to have an actual physical location with 50% of the members being physically present. So that means that any notice of these public meetings to conduct official business will need to note both the physical location of that public meeting as well as the information for how members of the public can participate virtually. Number 4, members participating electronically may be counted for quorum purposes. This is slightly different from the requirements that have been in statute previously for state agencies and/or state boards and commissions, where at times members participating electronically could or could not be counted for quorum purposes. Here, with the governing bodies of political subdivisions, they may be counted. And the last piece is that members participating electronically may participate in a final action, so long as the member can be seen and heard. This is also a slight distinction because in the past, members that participate electronically for state boards and commissions could be there to receive information, but in most circumstances were not able to vote on the final action being taken. Next, we deal with another one that related to virtual and electronic meetings, but it was specific to Conservancy District board members. In this case, because Conservancy districts at times could have members that are located at greater distances away from a central meeting location, they amended the open door law under Indiana Code 5-14-1.5 to allow members of these boards to attend meetings publicly through an electronic means. Next, we'll go to the Flood Control Board and what happens for a tie vote. Under Senate Enrolled Act 329, in addition to addressing what would happen for a tie vote, it also increased the number of board members from 5 to 6. With this increase, there is greater likelihood that we could see a tie vote occur. In the case of a tie vote, the executive of the city that is petitioning for the establishment of the flood control district shall act as the determining vote, and in that case would be the one to help break any ties that do occur. And those are the only other topics that we have for public meetings and/or public notices. As we've referenced throughout today's presentation, there is additional information related to a variety of different topics from the 2021 legislative session. These memos can be found at the department's website under the Memos and Presentations section. We have released, I believe, 4 or 5 memos at this time, but there will be several more that will be issued in the coming days. I know we did have a handful of questions that were submitted. I'll try to respond to at least one of them here before we run out of time. So one question, as a township, we review all of the appeals and we send Form 134s, which is the form that is submitted upon the completion of the preliminary informational meeting prior to an appeal before a PETA-BOA. Appeals are sent to the PETA-BOA if an agreement is not met at the township level. The county also sends Form 115 from the PETA BOA meeting agreeing with our findings. The question presented is, do the appeals settled at the township level not heard by the PETA BOA fall under the new legislation under House Enrolled Act 1166? Now, for this case, if there is a Form 134 that settles the issue, that the department has interpreted to fall under the settlement or agreements exception to the freeze period. In that case, it's something that there was an agreement that happened before a formal official hearing before PETA BOA. Kelly, did you have any other thoughts on that question?
No, I agree. I don't believe that a settlement at the informal level would trigger the freeze period for that particular property.
Thank you for that. And then we'll get to one additional question since we do have another minute here. This one is for the rainy day fund transfer threshold limitations, the increase of 10% to 15%, the 15% amount that is now able to be transferred into rainy day for the next 5 years. What 15% does this refer to? Is it revenue received? Is it cash balance? Dave, did you have any additional thoughts of what that 15% is meant to encompass for transfers to the rainy day fund for? I
don't know for sure. I don't know off the top of my head.
I do believe that anything that you have the authority statutorily to do a transfer to the rainy day fund for a particular purpose, and it could be unique or specific to the type of unit, would be captured in that increase from 10 to 15% for the threshold limitation increase that you'll see going into the end of calendar year 2024. We are kind of coming up to the end of our time period today, so I'm going to let Jenny take it over. I know she did have a few closing notes or remarks. You'll see on the slide before you right now information for us to submit any other questions. Again, any question that we received during today's webinar, we will include in a FAQ document that we'll be releasing in the coming days to address some of those additional questions that we were not able to get to. Jenny, I'll turn it over to you now.
Thanks, Emily. Well, wanted to thank all of you for participating today in the webinar. I know that our legal team has been working hard over the last few months, as Wes mentioned, and it's great to be able for them to be able to share this information with all of you. Just another quick reminder, because we did get a few questions during the session. The PowerPoint slides, the PDF, the video survey, and CE forms will all be sent out via email tomorrow to all registered individuals, as well as they will be posted on the DLGF website under the webinars page. You'll be able to see that where you registered. It'll be the same line with just updated links. So you can download those documents and watch the video and review the PowerPoint at a later time. I will leave the chat box open a little bit for the meeting. If you have further questions, you're welcome to enter those into the chat box, and I will make sure that our legal team has an opportunity to review and respond to those. So we will leave those up for a few more minutes. As a reminder, the CE forms, if you are wanting CE forms, we do not provide any type of certificates. But you will get a form to complete, and then that will be submitted to your governing body or how you have submitted those previously. If you have any questions, you can reach out to me and I will try to give you some direction. As well as if you are an attorney and you are needing legal education hours, please complete the survey and enter your attorney number into that survey, and we will get that filed for you. And I want to thank everybody for joining us today, and watch for that email tomorrow. And any questions can be submitted now for the next few minutes. Thank you for joining us today.